Good morning, hello and welcome to Moneycontrol's live stream. You're tuned into a fresh new edition of Opening Bell with me, Lovisha Darad. Well, we are back with a fresh day and it's the midweek now and looks like another quiet start for the Lal Street as the GIFT Nifty indicates as well. Yesterday, we did see that the market suffered the worst drop ever since the India-Pakistan ceasefire rebound was seen in the markets. So 2 days of consolidation we saw, but then yesterday, finally, the headline indices succumbed to the selling pressure and it dropped over 1% each. Now, today, the global screen also does not hold quite the optimism as we want. US markets ended lower overnight. Dow Jones was down over 100 points and even the S&P 500 has snapped its 6-day run-up. So, yes, what we'll be tracking today is the rising bond yields. The US 10-year yields, which is above your 4.8% mark, and 30-year yields, which continue to waver around 5%. So, that could be weighing on the sentiment too. On the other hand, if you look at the Asia Pacific markets, that were a bit better. Japanese markets rose despite reporting slowing exports for the second consecutive month. Other than that, Australia, Hong Kong and South Korean markets also opened with a very mild set of gains from the Asia Pacific. But yes, coming back to India, we will watch out if the Nifty continues to break below the 24,700 mark, and the stock specific action will continue. We have Dixon Tech, United Spirits, all of them reacting to its March quarter results. So keep a watch out for all these stocks in today's trading session. Also keep posting your stock related queries and we'll take them up shortly before 9:30 a.m. with our technical expert of the show. Now let's quickly take a look at the top headlines this hour. Stocks in the Wall Street have slipped overnight as tech stocks rally, lose steam. The S&P 500 end 6-day winning run while Dow slid over 100 points. Stocks in the Asia Pacific opened mixed as investors pass the China loan prime rate cut. The GIFT Nifty is indicating a quiet start for Indian markets. Crude oil prices hold steady around $66 per barrel as uncertainty lingers around US-Iran negotiations and Russia-Ukraine peace deal. Meanwhile, gold prices rise over 1% as dollar weakens. In key earnings, IndusInd Bank's net interest margins is expected to decline while slippages are expected to rise. All eyes will be on the new management team formation. Also watch out for numbers from ONGC and Colgate. India's diplomatic outreach following Operation Sindoor will begin today with the first of the 7 all-party delegation departing for the UAE. The delegation will engage on forging a united front against terrorism and pressuring Pakistan for removing terrorism from its soil. All right, like I was mentioning that the Indian markets and the benchmarks saw an all-round fall yesterday. We did see that the headline indices fell over 1% each in the last session, and that was the largest fall ever since we saw that India-Pakistan ceasefire announcement and the rebound that we saw following it as well. Now, the Nifty has fallen for the third consecutive session and it has broken below that of 24,700 mark. What's concerning for investors could be the reports of COVID-19 cases in South Asian countries. Other than that, we can see US downgrade by Moody's and rising yields in the US is also weighing on the sentiment. Yesterday we saw that 42 out of 50 Nifty constituents did end in the red, and the broader end of the markets, which were supporting and holding the fort for the headline indices in the past 2 days, also succumbed to selling pressure and they snapped their 6-day winning streak. All the sectoral indices plunged in the negative territory and auto and media indices saw the heaviest losses yesterday. Even the defense pack, which was rallying on the back of some spending optimism on the back of the military conflict, that also saw profit booking and the stocks fell for the second straight session. Now, going ahead into the week, we'll be watching out for the India-US trade talks, which is likely to happen in 3 stages. So, any optimism and tariff contours which will be announced can be appreciated by the markets on either ways as well. For today, some of the Q4 results that we'll be watching out, that is the likes of ONGC, IndiGo and IndusInd Bank. IndusInd Bank, more importantly, because the lender is expected to tip into losses. There will be more details on the interest income discrepancies and the new management team and what the outlook is for the going forward for the lender as well. Remember that this week itself, we did see some interest income discrepancies that came into limelight following the senior level exits in the lender and following the derivatives discrepancies that also came in the March during the month of March. Coming to some of the cues that will set the tone of the trade today, that is your first is your fund flows data, where we saw that yesterday FIIs sold stocks which was worth about 10,000 crore rupees in the cash markets. Now this is the largest quantum of outflows in over 2 months that we have seen. So that's quite a negative for the Indian markets that is coming in. On the other hand, DIIs tried to help a lending hand and they bought stocks which was worth about 6738 crore rupees in the cash markets. Coming to the option cues data, which is your Nifty put call ratio, that has fallen to about 0.69 levels, which was last seen in February 11 from 0.82 levels in the previous session. But since India wicks remained flat yesterday, so there could be some optimism that the bulls could be hoping for in today's trading session as well. The third is your F&O ban list on the screen. One new stock which has been added, that is your RBL Bank, and the stock that continues to be retained is your Manappuram Finance, and the stocks that have been out of the list, that includes the Hind Copper and Titagarh Rail Systems. So yes, all in all, a very muted start is expected for the Indian markets, given that 3 days of losing streak we have seen for the headline indices as well. But looking at the pre-open rates, that kind of signals a little bit of an optimism, because Sensex is about 140 points and Nifty is also above that 24,700 mark in the pre-open rates. But we'll just go to the open in just a couple of minutes. It's 5 minutes to go for the open, but let's quickly get on board with the technical expert of the show. Joining me is Ruchit Jain, Vice President Technical Research of Motilal Oswal Financial Services. Ruchit, good morning. Yesterday Nifty broke below that 24,700 too. What can we expect? A further downside on the horizon?
Yeah, hi, very good morning, Lovisha. Well, Lovisha, if we look at yesterday's trading session, then it seems more of a profit booking after that relentless up move which we have seen in last few trading sessions. The mid cap and the small cap indices had rallied without breaking its previous day low for 6 consecutive trading sessions, and the momentum readings were in a bit overbought zone due to that. If you look at yesterday's selling, it was mainly seems because of FIs, where they have sold equities worth over 10,000 crore in the cash segment. In the index future segment also, they have unwound some of their long positions. Their long short ratio has come down to about 37%. Although it does not vary for a broader trend, I think broadly what we have seen in the recent past, that most of the negatives have factored in, and other things such as dollar index, which is again hovering below 100, which is another positive factor for us. So I think this is just a profit booking that we are seeing after this relentless up move. The earlier resistance of 24,500, 24,600 zone could now become a support on this pullback move. So it remains a buy and dip market for us. I think the overall trend still remains intact. We may see some another 200, 250 points, correction from current levels, but around 24,600, 24,500, if the market comes, then that could be opportunity to create fresh longs over there as the risk reward ratio would become favorable again.
Okay, all right. 24,600 and 24,500 to watch out. But Ruchit, what about the bank Nifty levels? Because that moved below the 20 DMA averages, and what is next that we can eye out on these levels?
So broadly, we have seen some consolidation in the Bank Nifty since last 1 month. On 21st of April, exactly a month ago, Bank Nifty was trading around this 55,500, 56,000 mark, and still we are hovering near those levels only. So we have seen in last 1 month, the banking space has seen more consolidation, and that is primarily because the Bank Nifty had already seen an up move since the mid of March. And rest, there were many other sectors which had shown that relative underperformance. So I think some other sectors have seen a good up move now, be it auto. Some of the realty names have started witnessing buying interest. Even many of the PSU names, along with the defense space, has seen a good buying interest. So I think banking overall trend remains positive, but there are other sectors which have seen this pullback more in last few trading sessions. So I think if you look at this last 1 month's activity in the banking space, this seems more of a time-wise corrective phase in the range of 56,000 to 53,500. This has been a broad range of this last 1 month. So I think we should see a continuation of this consolidation in between 53,500 to 56,000.
Okay, all right. Time-wise correction expected for the Bank Nifty. Ruchit, I want to understand for the Nifty Midcap and Smallcap indices, because yesterday we did see that they snapped 6-day rally. So can we say that this is just the beginning of the consolidation going ahead?
So I think one need to be selective within the mid cap and the small cap space. These space have already seen a run up from the lows, and we are more focused on the large mid names. So large mid cap names which are there. I think those would see relative outperformance compared to the small cap stocks going ahead. So I think since small caps have also seen a good rally, it's good time to do some churning or some rotations in the portfolio in case of stocks are not moving, then one can look to shift out from the small cap names to the large mid cap names.
Okay, large mid-cap names where we can look at, but just less than 5 seconds to go before we hit the open. The first rates will be coming on your screen. On the pre-open rates, that was holding well for the markets because the Nifty was above that 24,700 mark. But yes, we have opened in the positive territory as the pre-open rates were indicating. 0.2% gains, very flat, quiet start for the markets, but holding in the optimism that we were expecting, and the rub-off effect that is coming in from the Asia Pacific markets as well, because that was trading largely in the positive territory. Sensex up about 140 points. Nifty Midcap and Smallcap also doing well at this point of time. The Bank Nifty index also after yesterday's downtrend is seeing a bit of an uptick with about 0.3% gains for the Bank Nifty index. Let's look at the other indices at this point of time. Nifty Auto Index, which was also one of the top underperformers yesterday, is seeing a little bit of a traction. 0.4% gain coming in for Nifty Auto Index. Nifty Metal with about 0.3%. Nifty Pharma Index with about 0.5% gains, and Nifty Realty Index soaring the charts with about nearly 1% gains or so. On the other hand, what is not doing well in this market is your Nifty Energy, Nifty Consumer Durables, Nifty Infrastructure, Nifty Oil and Gas Energy. All of these are trading with about mild set of pullbacks. If you look at the India Wix, that is up about 1% or so, and if you look at the mid cap and small cap indices, mid caps have turned it into the flat in the red at this point of time, and small caps also flat in the green. So yes, a very mixed trend coming in from the mid cap and small cap indices at this point of time. Coming to the top gainers and losers on the Nifty 50, we can see Dr. Reddy's leading the charts with about 1% gains. Hindalco doing well with about 1.1% gains, given that the India business growth have impressed the street, and we can see that the Hindalco is topping in the Nifty 50 gainers list. Other than that, Sun Pharma, Maruti Suzuki, Eicher Motors, some of the pharma and auto stocks have taken it up for the Nifty, and they are seeing a gain of about 0.5% to about 1% or so. On the other hand, if you look at the top losers on the Nifty 50, Eternal sliding once again with about 0.5% cut at this point of time. Trent not doing well. NTPC, Reliance, SBI Life, all of them in the top losers list at this point of time. But let's take one stock in focus, which was your Dixon Tech, because that reported quite good numbers from the Q4 perspective. The stock is seeing a bit of a profit booking, 4% downtick. We saw that the profit did soar about 332% year on year due to the one-time exceptional gain which drove the profit, and revenue was also up about 121% on a year-on-year basis. On the operational front also, we see a good performance. EBITDA up about 143% and margins have expanded by about 40 basis points. The stock, if you look at from a 1 month perspective, the stock is very flattish at this point of time. But then from the past, if you look at from the March lows, the stock is up about 20% or so. But Ruchit, what do you eye on the charts for Dixon Technologies? There are some brokerages like CLSA which is pegging a target price of about 20,000 rupees for Dixon Tech.
So I think one is studying this more from a longer term perspective, then we can keep a buy and dip approach. But at least from a near term trading perspective, it doesn't seem that we would see any kind of run up rally ahead of the numbers. Along with the markets, the stock has already seen an up move from 12,000 to 17,000 over last 1.5 months. And post numbers we are witnessing today more of a profit booking kind of thing. So I think one can wait for some more declines. Maybe if one is looking for a bit longer term perspective, and if the stock comes around that 14,800, 15,000 mark, then one can review for buying or long term investments over there.
Okay. Let's take some of the viewer queries which is popping on our screen. The first query coming in from Naveen. He's asking the view on Eternal And today also the stock is one of the top Nifty 50 losers list. We did see yesterday the company did come under pressure after the board started the process of conversion into Indian owned and controlled company, and that could potentially, the board can put a potential foreign ownership cap and could exclude from the MSCI index also. That's what Jeffries has been predicting as well. So you could see some sentimental reaction which is playing out in the stock. But from a 1 month perspective, if we look at for eternal Ruchit, the stock is quite negative. It's exhibiting quite a negative trend from 280 odd levels. It has come down to 220 odd levels. Can we expect further pressure and negative sentiment to continue?
So I think more or less price risk correction, I think already has been done in the stock from around 300 levels, which are seen at the start of December. The stock corrected towards 200, formed a good support base around 200 levels. It did showed some signs of breakout a couple of days ago when it went around above the 240 mark. But again, there is no follow-up move that we can see. So this is an indication of more of a time-wise correction getting continued in the stock. So immediately 220, 218 is the support zone for the stock. Till that is not reached, I think the short-term trend would tend to remain sideways, although some volatility would be there because of the news flows which you just mentioned, but it is expected to trade within a broad range of 220 on the low side and 250 on the high side.
Okay, 220 and 250, that's where you're mentioning about the range. And now let's take one more stock in focus, that is your Torrent Pharma, because the stock is doing well with about 2% gains. We did see that in the March quarter, the profit was up about 11% year on year, and the revenue has also risen by about 8% on a year on year basis. But Ruchit, if you look at from the stock is stuck in a range from 3,200 to 3,300 as well. Do you expect the trend to continue, or can we expect a positive move going ahead?
I think within the pharmaceutical space, if you look at last few weeks, it has seen more of a consolidation in Torrent Pharma. And the breakout for this would be about 3,350 marks. So in case that the stock manages to give a breakout about 3,350, 3,370, then one can expect a positive momentum. So good stock to keep on your watch list. About 3,370, one can create fresh longs over there.
Okay, all right. Let's take another viewer query. Naveen is asking that what is the fresh entry levels that we can watch out for NBCC. If you look at NBCC from 5 to 6 sessions, the stock has built on gold gains, 21% uptick. Can we expect the momentum to continue? And what are the entry levels you are watching out for, Ruchit?
Yes, so the short to medium term trend looks positive for NBCC. It has started forming that high top, high bottom structure, and price of moves have been supported by good volumes. If you look at recent activity, then 105 was the important resistance, above which the stock has given a breakout. So any kind of declines now, 105 should become a good support. 105 to 103 should become a good support zone for the stock. So I think it would be good to start initiating longs if you want to do at current levels, and keep some room that in case if the stock dip towards that 105 level, then you can add more positions over there. So if you're looking for a positional perspective, then I think you can buy a limited quantity over here with a room to average in case the stock dips towards that support of 105.
Okay, support of 105 that we can watch out for NBCC. Let's take another viewer query. Satya is asking that yesterday he booked profits in IndiGo, and he's asking what are the next support levels for the re-entry for next 12 to 15 months or so. He's asking the medium term levels for IndiGo. If you look at IndiGo, the IndiGo is expected to report its Q4 results today as well, and from its May lows, the stock has started to rebound with about 6% gains or so. Ruchit, what is the next support levels that Satya can watch out for in a re-entry on the counter?
So the immediate support for the stock is right around the current market price, at around 53.90 or so, which is the 20-day EMA for the stock. But this is a very short-term support, and on the RSI, there has been a bit negative divergence on the daily charts, due to which if we get any kind of dip towards its next support of 5100 to 5150 range, then the risk reward ratio could become favorable over there. So in case of dip towards 5150, you can take a review over there.
Okay, all right. Let's take another viewer query. Pooja is asking that she's holding PNB at 94 rupees per share. She's asking what should be the exit and stop loss at this point of time. PNB, she's seeing a little bit of a profit, 100 rupees, that is where it is trading at. What is your suggestion, Ruchit?
So it's more into a consolidation phase. 96 to 97 is a good support zone for the stock, which if it manages to hold above that, then we can see a gradual up move going ahead in PNB towards 105, 108. So as of now, you should keep a stop loss below 96 on your existing positions.
Okay, all right. Let's take another viewer query. Kishore is asking the view on Jupiter Wagons. The railway stocks did pick up pace during the cross-border tensions as well, and the stock was up from May low levels to about 15% or so. But any levels that you're watching out for Jupiter Wagons, Ruchit?
So I think a pullback move was there for 2 or 3 trading sessions, but frankly, no, the follow-up move would be very important to see whether a sustained buying momentum is there or not. Because we have seen in the recent up move, there's many of the railway names such as Titagar Wagon, RVNL, Railtel, Jupiter Wagons, they all did see some pullback move. But no, in case of the follow-up move is missing, then we could see a continuation of the consolidation between 330 to 420 on the higher side. So as of now, I think no one should still wait for the follow-up move to happen. If there is no follow-up move, then I think there could be some better opportunities in other space, rather than Jupiter Wagons.
Okay, all right. Let's take one stock in focus, that is your Ircon International, and we also have a viewer query on Ircon International by Rupak Mehta. We did say this, that the counter secured about 253 crore rupees contract from the Southwestern Railway, and they plan to implement Kavach across the Bangalore and Mysore divisions. The stock was down 4% yesterday, but today the stock is seeing good traction with about percent gains or so. Ruchit, Rupak is asking, should one look to invest in it from a perspective of a 1-year time horizon? So, any thoughts on that?
So I think no, similar as I said that the railway stocks have seen a couple of days of up move, but whether this would turn into a sustainable uptrend, which we have seen no, in the past as well, that is still a doubt, because the follow-up move would be very important to see. For Ircon, I think if you have any existing positions, you can continue to hold on. For fresh buying, I would suggest not to go buy 100% whatever quantity you want to buy, but go long on some partial quantity. Maybe you can add around 30% of the quantity that you intend to buy at current levels and watch for the follow-up move. If there is going ahead, then you can gradually add more portions later on. But for now, I think around 30% of whatever you want to buy can be bought, not more than that.
Okay, all right. Let's move on to another viewer query. Debu K is asking the view on Godfrey Phillips. If you look at from the 6 months perspective, the stock is on a stellar runaway as well. Very positive trends coming in for Godfrey Phillips, and Q4 results were also quite optimistic. Ruchit, anything that we can watch out? Any next target levels that we can watch out for Godfrey?
So overall trend remains quite positive for the stock. Recently, any kind of declines that we have seen in the stock, the 20-day has acted as a good support, which is now around 8,200 kind of levels. I think the uptrend remains intact. So existing positions can be held on. If the stock again continues this high top high bottom structure, then one can expect levels around 9,600.
Okay, 9,600, we can watch out for the counter. Let's take another viewer query at this point of time. Aman Kumar is asking, what about data patterns? Is it a hold or a sold stock for now? Data patterns, how does the counter look like? Valuations is a concern for the counter. In the past 3 months, the stock has rallied by about 66% or so. Ruchit, what is your view?
I think most of the defense stocks have seen such kind of rally over last 1.5, 2 months. But overall, I think we are quite positive on the defense space if one is looking from a bit midterm perspective. Since the stocks have already seen a good rally, if you are short-term trader, then you can look for booking partial profits over here. And any kind of declines, I think if comes again towards 2200, 2150 kind of range, then those would be good levels to create fresh long positions over there.
Okay, all right, fresh long positions over there. Let's take another stock in focus, that is your Brabon is asking the view on APAR Industries with a medium to long term perspective based on the current pricing pattern. APAR Industries is definitely a stellar performer from the past 1 month as well, Ruchit, and the strong Q4 also, brokerages are also seeing a good upside from here on, given its good March quarter performance. Anything that you're watching out for the stock going ahead?
So the mid to long term trend seems positive for the stock. Already the stock witnessed a correction in the month of December and January along with the broader markets. But at lower levels around 5,000, 4,700, the stock has formed a reversal pattern on the monthly charts. And we can see that Post that the stock has also seen a good follow-up move, with good volume. So downside seems to be very limited for the stock from here on. Existing positions can be held on even if you long want to create fresh longs. I think this is a good stock which you can add gradually at current levels, and add more if we get any dip around 6,500 to 6,700 range.
Okay, all right. 6,500 range is where we can add on. Let's move on to another viewer query. Ratna Kumar is asking, he's holding TCS for the long term and he's asking whether he should add in this present dip. What is your view on the counter on TCS and of course the IT space, because we did see Moody's downgrade on the US credit rating. Anything that you're watching out for TCS?
Can held your existing positions even if you want to go fresh longs. I think one can consider buying TCS as well. So the overall longer term trend remains positive, but short term it seems that we would see some time wise correction in many of these large cap IT names. Price wise corrective phase that has already been done because we have seen a long underperformance in IT names, mainly because of that trade war tensions which we had in the US. But since that trade war tensions has subsided, we have seen a pullback move in many of these IT names, but no seems that we would see some kind of time-wise correction in these names. Maybe in some of the mid-cap IT names, such as Coforge is there, Persistence is there. You can even evaluate to go long on those kind of stocks if you're looking from mid to long-term perspective. But even TCS does not seem that we would see any significant price rise down move from here on. But yes, some time-wise correction can be expected.
Okay, time-wise correction can be expected. Let's take another stock and focus because that is also buzzing in trade. That is your Whirlpool India. We saw that the profit jumped about 53% year on year and the revenue has also risen by about 15.6% year on year. If you look at the past 1 month performance, Ruchit, for Whirlpool, it's quite impressive with about 18% gains. Do you expect more gains to build in going ahead?
I think it's a pullback move around 1450. The stock again has a good resistance levels of its 200-day exponential moving average, which has not been broken since a long period of time. So, not recommending to create fresh longs, considering that the risk reward ratio is not that favorable. But around 1450, the upside looks kept in this for now.
Okay, all right. Let's take another viewer query. That is your Anunay Ricky is asking the view on EPAC durables. He's bought the stock at 407 levels. He's asking whether he should average, hold or shift to any other levels. 407, he's seeing a bit of a loss. 367, that is where the stock is trading at. And the past 1 month also the stock is exhibiting quite a negative trend. What is your view on the counter, Ruchit?
So I think more of consolidation signs are there in the stock and does not seem the volumes are not that very high, whereas sharp up move should be expected. On the higher side in this entire consolidation, 420, 410 has acted as a resistance, whereas on the lower side, the support has been in the stock around that 360 to 330 range. So overall seems sideways only, not expecting any significant trended move unless good volumes kick in.
Okay, all right. Just one last question before we let you go, Ruchit. We're seeing a bit of a consolidation at this hour, but what are your top picks and what are your top recommendations for our viewers?
So I think from a trading perspective, pharma as a space looks a bit positive. We have seen this space has gone through a good consolidation phase. No more because of that uncertainty which was there. Considering that how much the tariff would be there in the for the pharma names in the US. But somewhat I think more or less the things seems to be settled down, and we have seen these news getting factored in. So pharma stocks can be looked at current levels, and within the pharma names, Lupin is looking good at current levels. We have seen a good consolidation in the phase over here. Some correction was there. The stock is trading around its support, so downside seems to be limited. With a stop loss below 1950, short-term traders can go long for potential pullback move again towards 2100 levels.
All right. With that, we have to let you go, Ruchit. But thank you so much for your time, and we hope that we connect with you soon.
Thank you.
All right, let's take a quick check of the markets before we move on to our next guest of the show. We are holding in the green and Sensex is up about 180 points, 200 points, 256 points, the updated rates for the Sensex, and Nifty is also surpassed that 24,750 mark. So yes, we are optimistic in the optimism territory. But however, if you look at the advance decline ratio, declines have taken an upper hand instead of the advances. So there could be a little bit of a cautiousness which is prevailing in the markets because the India VIX is also up about 1% or so. If you look at from the sectoral perspective, Bank Nifty, auto indices, all of them doing well. Nifty Metal also eking slim gains at this point of time, and Nifty Realty Index definitely the top sectoral performer with a percent gains or so. If you look at the broader end of the markets, the mid cap and small cap indices, very mixed trends, very muted trends. Small caps, with about flat in the red at this point of time, and mid cap also flat in the green. So yes, the large caps overall is leading today's upsurge at this point of time, and not major support is coming in from the broader end of the markets as well. But with that, let's move on to our next guest of the show. We have market expert Sunil Subramaniam joining us. Sunil sir, good morning. So good to have you. FIIs have sold for 2 straight days now, and now we are seeing 30-year bond yields rising in the US, 40-year Japanese bond yields also rising to about 3.5%. So what does it mean for Indian markets, and especially with the FII flow picture going ahead?
I think that naturally the downgrade and the resultant yield moves could have done some equity versus debt allocation changes in FIIs broadly, because it's generally, this is a signal for getting risk off the table. And any fresh allocation, like you said, 30-year US Treasury is at 5% plus, 10 years are at 4.5%. So maybe there is some reallocation going out of the equities basket into the debt. But I think it's going to be a short-term phenomenon, because it's just the trigger of the downgrade. I think it's a news which already was there in the pipeline. The other 2 rating agencies had already downgraded the US. It's just that sentimentally it's affected the market. Second is that I think the FIIs are also the hedge funds, I would say. Those who moved into India in the last few weeks are probably booking profits. So it's just they're taking some healthy money off the table. I am confident that they will come back as I see. They're probably a little bit worried about valuations in specific pockets, which have run up a lot. They probably will re-enter as the market readjusts. I don't see this as any long-term negative trend from FIIs on India.
Okay. Sunil sir, you did mention about the earnings front as well, because now the earnings yield on the Nifty 50, that has fallen by about 64 basis points since the end of Feb. And if you look at the yield on 10-year bond yields, that have risen about 27 bips. So a negative spread can also act as a headwind for the sustainability of flows going ahead. Do you believe so?
Not really, because I think in Indian market, I don't think there's so much of a interaction between the debt and the equity. FIIs are very flexible there. But I think Indian fund managers, if you have money for equity, you'll put it in equity. You have money for debt, you'll put it in debt. You have very limited flexibility to take equity money and put it in debt. So the Indian market, I don't think these yield gap differentials are generally shown to say that for investors to make an allocation, they are used to say that now, equity may give debt-like returns, so shift. But that's a very broad level thing. But the money in the market is heavily in favor of equities. Even last month, you saw about 25,000 crores fresh money coming into equities. This is apart from what came into the hybrid funds. So I don't see this, as far as India is concerned, this yield gap differential driving flows from equities into fixed income at all.
Okay. So, sir, what about the Japanese bond yields? Because if they continue to rise ahead, can we see a similar fallout of yen carry trade of last year?
So I think that's also slightly overdone, because see, what happens is that this yield going up. So if the Japanese investors, right, are looking at comparative markets, because Japan as an in-house investment destination, because of low interest rates, has always been not a preferred destination. Now, I believe that to the extent that people borrow money on the Japanese yen and use the carry trade here, the costs obviously are going up because of the yields going up. But my sense is that pure Japanese FII money is not leveraged money, because Japan is an export surplus country. They have enough surpluses there. It's players from other countries who tend to borrow in this currency war and get in and try to make money both on the currency and on the underlying stock markets. So there could be some shift in those kind of carry trade ventures. But I think from last time's time, there's already been a lot of readjustment happening, because the currencies all have moved very crazily since the last time we saw the yen trade collapse. So I don't think that in the recent past, with the Japanese yields already having risen, the carry trade is that big a part. Pure Japanese FII money is coming in, and I think dollar money is been coming in straight away. So the quantum of carry trade compared to last time is not as great. And so any readjustments there, I don't expect a major fallout on Indian equities.
Okay. So, sir, now that we're in a consolidation phase in the markets, what would you suggest for the investors? Is it a buy, sell, or a whole market at this point of time?
So I would say that if you have a year and a half outlook, it's a hold market. If you have a longer period than then, it's a buy market because all the news around India is by and large positive. You have 100,000 crores of tax giveaways flowing into the system. You have an RBI dividend of around 2.5 to 3.5 lakh crores flowing into the system through the government. You will have a rate cut coming in. You have the potential BTA signing happening sometime. So I don't think there's any negative news for people to sell in this market, right? The people who are going to be selling here are the short-term hedge funds from foreign who made a lot of money out of India. But as far as domestic investors are concerned, yes, if you have a shorter term outlook, the market's rally in the recent past has probably discounted a lot of the good news. We know that the earnings season guidance was not great. It is my belief that the actual earnings, when they come through in the coming quarters, will beat the guidance because the guidance were overly pessimistic because of the trade war overhang. So I think that the news will only get better and better as we flow through the quarters. But yes, today, because of the recent rally, which happened on the back of a relief on the Indo-Pak ceasefire, on the relief on the international front with Russia and Ukraine talking, that's what led to this rally. So probably a lot of the good news is in the price. So in the short term, if you're expecting very rapid gains, that may not be good, but I would suggest that you just hold it there because new good news either from the BTA or from the RBI rate cut would help the markets get a fresh leg up. So stay invested in that sense. But if you're a longer term investor, then it's a good idea to start buying into this market, especially in days like yesterday, right? So buying on dips in a staggered way is a very good approach because I believe in the next 3 to 5 year time frame, Indian markets will give very good returns as this whole trade war scenario goes into the backseat and India's own whatever status as the fastest growing country with very good fiscal status dominates the play. So that's my suggestion. Either you hold for short term or you buy for the medium to long term.
Okay, okay. Sunil sir, you did mention that the earnings guidance has been quite pessimistic from going forward. So, would you recommend investors to reset their return expectations for a 3 year long-term horizon? Because in this consolidation period, also we can see that the valuations did become exorbitant, and that became a concerning point for the street going ahead.
I think you're right there. That's why I recommended a hold for people with a 1.5 year outlook because you're right that the valuations today seem rich. But like I said, that richness is coming because of the pessimistic guidances because these are all forward P's. It's not the trailing P's, right? But my sense is that if you go quarter on quarter, you'll find the valuations becoming more reasonable, not because the market is going to be flat, but because the earnings are going to get upped in terms of the guidance in the next quarter and the following quarter. So I think that I'm not overly concerned from valuations unless you're a very short-term investor. Then it definitely looks very overvalued. From a medium-term perspective, I think the valuations are reasonable. And if you hang in there, I'm sure those returns would come through.
Okay, okay, okay. Ruchit sir, everyone is talking about narrative stocks and the bloated valuations that the space presents. Would you also recommend investors to stay away from these narrative stocks, be the likes of PSUs, capital goods, railways theme?
And defense you didn't mention, right?
Yes, of
So
course,
the
defense.
top narrative stock. So yes, see, the narratives play is a very hard one to really say because the narratives are good. The problem is that the price already reflects the narratives. And retail investors tend to follow the trend. So because these have been rising in the recent past, they go jump in there. So from a retail investor's perspective, I would say definitely you should exercise caution when you go into narratives because when the narratives come into the public domain, it's probably a bit too late in the day, right? So but however, I still say that the narratives are not on any weak ground. They are pretty strong grounds. For example, defense, as I mentioned, this Indo-Pak war has probably led to a reset in terms of at least 50,000 crores of additional order book. The narrative on defense is also supported by the fact that Europe is now going to be building their own arsenal because they can't rely on NATO. So So they're going to be buying. And India's capabilities, the war, Indo-Pak war has shown our capabilities in modern technological warfare like UAVs and drones. So export order books are also likely to come. The third part of this narrative is that this has been focused largely on the PSU defense mechanisms, right? Companies. But there are a whole host of private sector companies which have been supplying all this to the Indian Defense Forces, who would probably come into the market and list. So the space is going to expand. So I would say the narrative is pretty strong. Today's prices have taken the good news into account. So don't expect short-term gain. So if you're coming in with a short-term outlook, definitely, you're taking a high risk, high reward bet. That's based on your risk capital. You want to take that. But if you're a medium-term outlook, I still feel that the narratives will deliver returns. So I don't say that these narratives are on any weak ground. To me, all of those sections that you mentioned, right, especially railways, the infra play, all of these, I think, are going to be good stories to hold for, where the government support will continue. So, like I said, again, short term, it's a high risk, but in the medium term, I would say it's worth holding.
Okay, okay. Sunil sir, I want your view on the IT sector also, because given the Moody's downgrade that we saw, so everyone is a little cautious about the export-oriented theme. Also, yesterday we saw that the Nomura has given out, they did meet the CFO of Infosys, and they said that the revenue growth guidance for FY26 is about 0.0 to about 3% in constant currency terms, while the street was already working with about 3 to or 4% in constant currency terms. So what would you suggest for IT sector as a whole going ahead?
Actually, I've changed my mind a bit about IT. I'm now more feel that it's a buy on dips, because I feel that the correction is a bit overdone. And I see that the downgrade of America as a credit, I don't think is going to affect American corporates in terms of their business plans. So if the America-China trade talks go well and they come to a reasonable conclusion by the end of the 90-day period, if India's BTA with US comes well, they've already done a UK BTA America. So I think that the tariff related uncertainty, if that goes away, and we know clearly that, okay, with China it's going to be 15%, India is going to be 20%, whatever it is, that going away of the uncertainty is a big relief to American corporates. They can make their plans. And I think IT will be a big part, because in this ever-changing world of AI, they need IT consulting even more. So my view is that the sentimental correction that's happened in IT because of this, right? I think it's a bit overdone. And I believe that if IT would be a buy on dips for me, because I believe that when FIS consistently invest in India, IT is one of their favorite sectors. And so we should also be buying something that will be bought by your big ticket players, which will be IT. So my view there, I was a bit negative a few months ago, but I'm now changing to say that it's good to accumulate IT on dips.
Okay, okay. Since you mentioned that, now that the FIs are buying, so they'll be favorable towards the IT sector also. What about the banking space? Do you believe that the run-up that we have seen in the past couple of months is already quite overdone compared to how the March quarter performance fared out?
Yes, in the way that you framed it, that related to the March quarter performance, yes, it looks like that. But I would still say that that's the most positive sector still in the market. So that has been already recognized. That's been the rally, right? Because you have the RBI rate cut, low inflation, money in the hands of the middle class, a good monsoon putting money in the hands of rural India. So a broad-based consumption rally, realty will also rally, auto will also rally. So banks are ideally positioned to capture this. But my focus there would still be on private sector banks, because not only this boom I see in the immediate future is going to be more of a retail middle class boom, where the private sector is far better geared on a quick turnaround, quickly passing on the rate cut benefits and taking advantage. Plus, the private sector also benefits because most of the large private sector banks are also very, very good distributors of mutual funds and portfolio management and insurance and all of that. So this 100,000 crores of cash is not going to go all into consumption. A lot of it will be diverted into savings. And I think equities you've seen that through all of this volatility, our SIP book has remained rock solid. So with now these things easing a bit, I see the SIP book growing, and I think the benefits of distribution income to these banks will also kick in. There might be some NIM pressure in the near term, because when you have a rate cut, right, depending on how fast you can cut deposit rates versus lending rates, and there I feel that again private sector banks have a slight advantage, because all their auto loans and their personal loans are fixed rate loans. So any drop in their deposit rates will improve their NIMs on that perspective. Where they'll probably suffer is in lending to the high-end corporates who will get their pound of flesh in the housing loan sector, which is very competitive and probably on a more floating rate basis. So I would still back the private sector, despite the run-up that's happened, to deliver good quality earnings growth, right? Because even any small compression in NIMs would be compensated by a growth in the loan book. So I think they will come out. PSU banks might get a little bit of a hit initially, but over the medium term, they will also come back on, because this consumption boom should lead to a capex drive in the private sector, maybe in about a year and a half. So from a medium term perspective, PSU banks also are reasonably okay. But to me, the private sector financial institutions, I would say, are still worth a bet on, given how the economic scenario is going to pan out over the next 6 months.
Okay. All right. With that, we have to let you go, Sunil sir. But thank you so much for your time, and we hope that we connect with you soon. Always an insightful conversation with you. All right, let's take a quick check of the markets. Well, we are holding quite well in the positive territory. Sensex is up about 500 points and Nifty is also above that 24,800 mark. So we did start with about 24,700 and we have crossed that 24,800 barrier as well. If you look at the advance decline ratio at this point of time, the advances have taken an upper hand at this point of time, while the declines are slowly getting trimmed down. On the other hand, if you look at the majority of the sectors have flipped into the positive territory, barring the Nifty consumer durables. Other than that, we can see Bank Nifty, Nifty Auto Index also trading with a good set of gains. Nifty Pharma Index definitely the top performer today with about 2% gains coming in. On the other hand, if you look at the small cap and mid cap indices, which were trading with a bit of a cut in the early opening session, is seeing it's back in the positive foot, and mid caps with about 0.5% gains, small caps with about 0.6% gains or so. But yes, pharma stocks, that is leading the rally today. We can see some of the top gainers on the Nifty 50 also dominated by the pharma names: Sun Pharma, Dr. Reddy's, Cipla, Apollo Hospital, all of them doing well, given that we have the COVID virus scare in the South Asian countries, and that is what is making all the pharma stocks getting perked up in trade as well. But yes, with that, we have come to an end of this edition of Opening Bell. Don't forget to tune in at 3:30 for closing, and we will be discussing about how the market is developed and what the stocks were in focus. Until then, signing off.